if you don't understand where the young are seeing the world going, where they're seeing their art going, where they're seeing their memes going, where they're seeing their trading going, where they're seeing their assets going, you're going to miss out on the biggest opportunity of a new generation of technology exploding. And
Broadridge just dropped a massive study with over 300 financial institutions across North America and Europe interviewed. The takeaway: custodians, asset managers, and banks are now operationally integrating tokenized assets, not testing, integrating them.
I love our community. There's just a night and day difference when you go into one of our Zoom calls during the week discussing where the market is at compared to going on X to see where the market is at. It's a 9-day difference, and we've been on point all year long. All 2025, we've been on point. And yeah, huge shout out to you, bro. You're the leader. So
let's get it, man. Well, we got a good breakdown for you guys today. We're going to dive into some panel discussions, keeping it real with you guys, all institutional based insights, showing you guys that this space is far from over. The bull run, the adoption, the institutional interest, the yield generation, the momentum that's underlying crypto is still there, relatively speaking, risk off sentiment due to some underlying fundamentals. But once those are behind us, I've been a firm advocate of staying buckle up, because we are still front running the financial institutions right now. The vast majority of the volume and volatility that has existed in crypto has been driven by retail and retail leverage at that. So do you really think that, considering that we're on the verge of institutional adoption, ask yourself this question: were they really going to let a bunch of over leveraged retail traders become overnight success stories before they got into the market? Absolutely not. So what are they doing? Most likely clearing out the over leveraged positions that exist before they come in, before ETFs, before regulatory clarity, before all these things finally materialize, which is happening. I want to start off here with this post because this backs kind of what I'm saying. This is Sandy Call from Franklin Templeton, who has also valid and active credentials. We've talked about her before on this call, on this platform, from the World Economic Forum. She's an advisor at the DTCC. She's an advisor at the CFTC, or a board member at the CFTC. She actively works right now at Franklin Templeton. Listen to what she says, because this is only from just a couple of months ago, about how we are still front running the institutions. And then I want to play another video clip on how we are on the verge of regulatory clarity in the space for the first time ever in crypto history.
Kind of a cheat, because you should really be answering this question. But I will do my best to answer for you. I would argue that retail has beaten institutional to this space already. That retail already understands the crypto markets far better than any institutional players understand them at this point. And that the capabilities and the functionality that the institutional financial services markets are going to need to develop are all coming now from the retail side. The gamification, the social interaction, the inclusion of short form video as forms of instruction, the ability to take actions on one's own that equate to what institutional players can do today, the ability to transfer assets peer-to-peer. These are all activities that retail are used to, and they operate with day to day in their everyday life. It's our institutional industry and it's our institutional rails that have kept us from keeping up with that level of innovation.
I wanted to start today's breakdown off with that because of this post that I share with you guys, where I said here, just to kind of keep you all on the right mindset during this market pullback, I want to remind you all, clear regulation is coming for the first time in crypto history. Clear rules for institutional investors to onboard into this space will exist before year end 2026, and likely a lot sooner. Now is not the time to be bearish on crypto. Now is the time to position for a future where retail is no longer front-running institutions. Like you heard Sandy Qual say, that's not my perspective. That's coming from somebody that has institutional background. And position yourself before the institutional floodgates have fully opened. That's the mindset that I firmly believe everybody should have right now. Look at this pullback as nothing except a beautiful opportunity. So playing this here for you guys, mentioning regulation is coming and that the crash was a blessing in disguise. Take a second and listen to this recent CNBC TV report from just the other day.
Welcome back to Worldwide Exchange. Turning to Washington now, where the wheels, they may be starting to move again on a bill to regulate and establish guardrails for the crypto market. Our Emily Wilkins joins us now with much more on this story. Emily, good morning.
Good morning, Frank. Well, yeah, there is some new hope that a major crypto bill could see its first votes in the Senate next month after bipartisan talks around the measure have restarted. Coinbase CEO Brian Armstrong was up on the Hill yesterday meeting with senators about the legislation. It's a top priority for the crypto industry, would define when crypto would be a commodity versus a security. And Armstrong told me that while some issues do remain, he is seeing progress.
Market structure legislation for crypto has made really good progress. I think we're 90% of the way there. The Senate Banking Committee is also working on their next draft, which we're told is going to get to a markup in December. So seems like good progress from the meetings that I've had today.
Movement on the bill stalled the other month over a leaked proposal from Democrats that would have expanded regulations of DeFi. Now, Armstrong said that many Democrats he has spoken with have now disavowed that draft, said there are discussions of finding maybe some sort of middle ground, potentially something that would allow DeFi participants to voluntarily verify a customer's identity.
In certain markets, people want to know who their counterparty is. Maybe they only want to trade with other accredited investors or institutions in the United States, for instance. And so I could imagine there being use cases that some market participants want to engage in that. But I actually think the decentralized, permissionless, open to the whole world is kind of more exciting and more higher potential impact. And so I want to make sure that that core piece gets preserved.
Discussions are still ongoing, but timing to pass the bill is now down to the wire because even if these Senate committees vote next month, the entire Senate and the House are going to need to vote as well before those midterm races get underway next year. Frank?
So I wanted to play that because it kind of puts the timeline a little bit more into a reality check for people. You know, she said that even if they vote on the bill or pass it next month, it still has to get sent somewhere else for them to vote on it again and push it through that. So it's like, you can't expect, we as retail traders with all the hopium and hype that's presented to us, to expect a super huge, massive bullish recovery and freaking $1,000 price predictions if institutions, which institutional money is what's going to get us there, don't even have the legal clarity to come into this space yet. So that's why I wanted to play this for you guys, to give you all kind of like a reality check and set the tone for yourself heading into 2026 as to what to really expect. Once this stuff is passed and once the regulatory guidelines are clear and the road is paved for these institutions to really onboard, I firmly believe that they will allocate way more than what they're allocating now, but that has to happen. These institutions will not come into this game full force like people are trying to get you to believe until this is in place, right? So just trying to bring people back to reality with that one. Coming over here, that leads me to this post, because this one was a really great wake-up call. It says, you do not want to miss out on the biggest opportunity of a lifetime. This is from Future of the Global Markets 2025 event that took place at Citadel Securities. And this is an interview. This is from October 7, 2025. So again, literally the day after, think about this. There's no coincidences in these markets, guys and gals, whether you believe in theories or moon cycles or fundamental data or whatever it is, nothing is a coincidence. It all happens for a specific reason at specific times. This gentleman was on stage saying that you do not want to miss out on the biggest opportunity of a lifetime the day after the total cryptocurrency market cap topped out on October 6th at $4.24 trillion. Right? Sitting in a room full of institutional investors with some of the biggest names in the game, listen to what he's saying.
Follow culture and follow money. There is no other today for the next 10 years, if you don't understand where the young are seeing the world going, where they're seeing their art going, where they're seeing their memes going, where they're seeing their trading going, where they're seeing their assets going, you're going to miss out on the biggest opportunity of a new generation of technology exploding. And I will say with one sentence, I said everybody in the world should own Bitcoin, which I'm glad a lot of you do as a way to understand it and prove it. You should do the same with stablecoins, and you should do the same with NFTs and art and meme tokens, because there's no other way to understand where this is going.
Yeah, he just he says there's no way to understand where this is going. So spread your eggs, across multiple baskets in a nutshell.
Because he said meme coins and because he said NFTs, people are like, oh, why the heck would you own those? Well, institutions are, that's why. Okay. And if you're not understanding that, guys and gals, again, you're not locked in with the right research. So let us show you that. Here, let's go back over to Franklin Templeton, Sandy Quall, sitting on stage with an ex-BlackRock representative of over 20 years of experience at BlackRock, openly mention and confirm that they not only invest in meme coins, but that they trade meme coins, right? This is a huge confirmation. And I'm not sitting there, supporting meme coins by any means necessary, because personally, I don't hold them in my portfolio. I hold one meme coin and that's it. I'm not going to disclose which one that is, but I don't hold a lot of meme coins. But nonetheless, if you do your research and if it has some potential and if you have the risk tolerance, could it be a good diversification option? Possibly. And it's not something that you should ignore or just shy away from. Instead, you should be open-minded to the technology. You should be aware to the transformation and not married to some bias on one specific project. Take a second and listen to Sandy Quall mention that they trade meme coins at Franklin Templeton.
8 different chains, and we're running node operations on 12 different chains. And so we operate also as very much a digital native. And we have really come to understand the value in the ecosystem, right? The speed of development, the interoperability, the ability to structure trades in all new ways that were impossible even just a year or two ago. So we believe very strongly that there is so much value to unlock in these protocols and in these new altcoins that are coming to market. And we believe that this is going to be, as people become more and more comfortable with it, with a good regulatory framework, this is going to be an opportunity on par with AI. So we really kind of see both sets of opportunities and are looking to really build across both areas.
Joseph, before we come to you, did you say altcoins? Does that mean meme coins?
Yes, well, we actually have published research and we have a whole theory that meme coins actually reflect a new style of investing from younger investors that want to trade fast-moving, viral trends, and that there's a whole set of crowd factors that we've identified that help drive value around those meme coins. So yeah, we trade meme coins as well.
Love it. Joseph?
I love that right there, because it completely crushes anybody that doesn't have credentials. That's like, oh, institutions don't touch meme coins. Yeah, they do, so don't knock them off.
And they're validators on 12 different chains.
On 12 different chains, generating yield. Second portion of that previous video that people did not like is that he mentioned holding some NFTs. Well, a lot of people don't understand that these institutions are going to be able to utilize NFTs and post them as collateral, lending, borrowing, liquidity providing. And NFTs go so much deeper than just pieces of art, digital art. They're going to go into like legal documents and, house deeds and so on and so forth. All right. So don't just knock the technology because you don't understand in a general package term what an NFT is or what use case or utility it can provide. Instead, shift the mindset and do research. Here, we always attempt to just give you guys institutional insights. This is a market maker, Key Rock, sitting on stage at a recent event that took place in 2025, talking about how NFTs are going to be utilized in the future as collateral.
And they were just, traditional assets versus digital ones.
And borrowing against them being one of the key things?
I mean, it's one of them, definitely. And I think that when you think about how big could it be, I think it can be absolutely gigantic. If you look at the most extreme examples, and again, like what we do on NFTs is, it's kind of funny, right? But can you imagine that I'm currently issuing loans, taking pictures of cats as collateral? And it works. Why not? I personally would not put a tremendous value in a picture of a cat, but it's tradable, it has a market, it has liquidity. You can use that. And of course, that's the most extreme example. But if that's the extreme, imagine everything that you have in between stable coins and pictures of cats. There's loads of assets that you can use, as collateral, and loads of different types of value that people would put on it. So the size of it can be absolutely gigantic.
Yeah, and one of the,
and that's coming directly from a market maker in this space. you know? So just to give you guys some food for thought, don't always just listen to the average closed-minded retail trader on the internet. Broaden your horizon, diversify your portfolio, understand the entire spectrum of Web3 and these new digital technologies, and don't just be biased thinking that there's one chain or one coin that's going to rule them all, right? So with that being said, coming over here, starting to get into, because he mentioned and talked about posting NFTs as collateral. Well, let me show you guys that these institutions, something that myself and Aqua have been screaming at the top of our lungs, is that double-digit yields is going to become the new normal. And these institutions are 110% aimed at not only providing that for their clients, but utilizing it themselves. Broadridge just dropped a massive study with over 300 financial institutions across North America and Europe interviewed. The takeaway: custodians, asset managers, and banks are now operationally integrating tokenized assets, not testing, integrating them. Institutions are chasing higher yields, more flexible structuring, and improved liquidity through tokenized secondary markets. And here's what most people don't see: that these same institutions are now starting to use DeFi protocols to generate additional yield for their clients, which is why me and Aqua stress so much to come tap in with us in the Wealth 28 Club and learn about DeFi, learn how to get your digital assets working for you. Because look at what they're doing. Look at this. This is directly from Broadridge. I'm not going to read the entire thing and bore you guys to death, but right here, it goes on to talk about how beyond enhancing transparency, liquidity, and access to new asset classes, tokenized assets allow firms to leverage DeFi protocols to generate additional yield opportunities for their clients. This is directly in a Broadridge document from this year. Talks about the regulatory snapshot and how once the regulatory landscape is firmly in place, that these institutions will onboard into this ecosystem. And then right here, it says institutions are motivated because access to higher yields, more flexible structuring, and the ability to improve liquidity through tokenized enabled secondary markets is now available, right? So in this document, they're talking about chasing higher yields. They're talking about earning on their digital assets and on their portfolios. So you as a retail investor, what does that mean for us? We should be attempting to do the same thing to keep pace with the institutions, which leads me over here. This is going to roll us into our Metallicus discussion today, because these are two very important comments that are coming directly from individuals that either work with or work for large institutions. The first one, this gentleman here, goes on to talk about how cash flow is king, compound interest, and how it's the strongest force in the universe. Take a second and listen.
Comes down to velocity, comes down to velocity and continuing to fundraise, sort of cadence of public awareness, and then being sort of north of minimum scale that, to Lauren's point, only a few will survive. The history of business would teach us that compound interest is the strongest force in the universe. And so whoever produces the best cash flow will eventually win. And I think the people getting smart about and deep about their risk-adjusted cash flow will be the DATs that emerge over the long term, because there will be points where right now everybody's trading at a premium to MNAV, but there will be points where people trade at
not everyone, not today.
Sure,
today.
But there's a lot of premiums to MNAV out there, but there'll be a point where there will be a lot of discount to MNAV, and that's going to be a moment where cash flow matters, where capital markets analysts are going to go back to what is your multiple on discounted cash flow.
So the premium will represent their ability to generate cash flow.
Yes, and the ones who are thoughtful and open-minded about generating that cash flow will be the ones that will win, and that's been the case for the entire history of the space. Being closed-minded to new innovation has never been a good investment strategy in the history of crypto.
Being closed-minded to new innovation has never been a good investment strategy in the entire life cycle of crypto. And he's talking about how the people that learn how to generate cash flow are going to be the people that come out on top.
Yeah, he's talking about businesses as well, institutions as well.
Think about it. Really put yourself in a position mentally where you say to yourself, you know what? These dudes that have been telling us cash flow is king. Well, look now. October 6th was the local top in crypto. The market shed over $1 trillion in value. You most likely, just like the vast majority of other people, did not sell the top. right? So what would have been the best strategy between now and wherever you think this market's going to go in the future? The best strategy would be for you right now to be generating yield on your digital assets and just using the market's money to compound and restake or recompound, provide liquidity, or take the yield and put it into other positions to maximize the yield and grow your portfolio during this entire downturn.
Facts.
Yeah.
Facts.
But because of ego and because of misaligned influencers on the internet, people won't have that awakening because they're distracted. They're distracted and manipulated.
Yeah.
So it's sad to see, but it's the truth. And we're here in this community to put out the truth to you guys, not the stuff that everybody wants to hear, but the stuff that you need to hear. Second thing that was stated in this panel discussion is that these institutions will need to understand altcoins and new DeFi technologies if they want to survive. So here this gentleman goes on to talk about that. And what I stated is that what this means for retail is that we should learn how to generate yield on the most secure, fast, and scalable chains in the game. And we should have a long zoomed out perspective. If that's what the institutions are doing, we should align with that and we should do something similar, right? Because I follow money. And if that's what the smart money's doing, why would you not want to be a part in that, right? Take a second and listen.
And the way I look at it, like a Polkadot, it's an infrastructure play, right? I think, when Gavin built this solution, he built it because it solves what Ethereum could not. And this is scale, this is throughput, and this is governance and security. So I think about, as you look at these asset classes that you want to get exposure to, you think about what it can offer and how you think about positioning that exposure. We're talking to RIA firms and everything, and you can look, Rick Edelman would always say, hey, you should allocate 3% of your portfolio to cryptocurrency. And now that is moving up to 30%. Now, predominantly, I'd expect most of that to be in a Bitcoin exposure position. But as we educate institutions and end users on, like I said, these asset classes, we can start to see that trickle down effect into altcoins, which are these more technologies that people get a better understanding. And as everything moves on chain, people will need to understand how these all play a role in the ecosystem.
This gentleman said that institutions are going to need, in order to remain adaptive, they're going to need to learn about these new technologies, DeFi technologies, altcoins, and that once the regulatory guidelines are clear, they're going to go from a 3% allocation to a 30% allocation. Again, I'm trying to show you guys that right now we are still in this window where we're before the institutions, y'all. All this price action. Go ahead, Aqua, because you unmuted.
Is 3 to 30, is that a 10x?
Yeah. We're before, we're literally, as a retail investor, you have to understand, we've positioned ourselves before all of this. And so that comes with a certain level of maturity and discipline and just sound understanding that you have to have, not only about the markets, but about yourself. Because in between now and whenever institutions actually flood in, you're going to be manipulated by a bunch of little tiny in-betweeners, in between market cycles, in between price predictions, in between this, in between that. And the real question is how are you going to survive that? The best strategy, in my personal opinion, without leverage, is to stake an asset, secure the network, be a node provider, generate yield in a wallet or a cold storage device that is safe and secure, and hodl down for the long term while you're generating passive income.
Facts. There's a big difference between that portfolio that does that and the other one that doesn't do that. Big difference after the course of 3 to 5 years. So DeFi is the way to continue to maximize your portfolio every single day. And this is what they're here for. These digital assets weren't created to just chill in some cold storage wallet. No, they were meant to get put to work. The technology get put to work. So, and we've been screaming DeFi for going on almost 2 years now. And all we're seeing is just more and more DeFi news like this, and DeFi is just continuing to get bigger and bigger and bigger. And then eventually it's just going to be right in front of your face everywhere you look, especially with what Metallicus has going on. Sounds like coming very soon, we're going to be able to have our digital asset, at our local credit union. But yeah, time will tell.
DeFi is going to be that niche category in crypto that right now nobody understands, but it will be the niche category that is one of the biggest, if not the biggest, in the future, and one that everybody uses. One that everybody uses, even in probably your average traditional mobile banking app, is going to be sat on DeFi rails, where you're going to be earning yield on your savings account. That's going to go from 0.05% or whatever it's at now to 4% or 6%, or in even some cases, maybe 9 to double digit percentages of 12 to 15. And that's all going to be sat on DeFi rails. So just again, behoove you guys to learn it and take advantage of it now with whatever risk adjusted approach you're willing to approach it with. Because again, you do need to be mindful that there are risks involved, but there's ways to mitigate those risks. It's just going to benefit you long term.